Skylar, we're citing this as the big macro risk event because of the stock market volatility. We've also seen some of the correlations drop, Bitcoin aside, between what you see in the stock market and what you see in other parts of the market. Is this as macro of an event as everyone thinks it is?
I mean, yeah, certainly it's a very macro event. So my colleague Mark Cudmore has done work on what happens exactly after Nvidia earnings are released. And what you typically see is that, yes, Nvidia earnings are actually usually very good. They kind of support what we've seen from the rest of the tech sector in that those earnings validate your valuation. So there's a reason the valuations are so high. But despite that, you get a sell-off in the days following because it's just not enough for the market. And because earnings in Nvidia matter so much globally, or to earnings generally, the overall picture, you get feed through to other markets as well. So something like the Euro stocks is only 13% tech, but I would expect to see a feed through to the Euro stocks as well. And understandably then, something like tech or industrial is more susceptible to that sell-off, whereas if you look at, say, utilities, that's more of a defensive stock, that might outperform.
And what do you think about the correlation to cryptocurrencies? Do you think that will stick? We've seen a big drawdown in Bitcoin alongside this NASDAQ move. Is that a correlation you think will continue?
I mean, yes, I think the correlation naturally happens because you have things like retail flows that go into both. People are looking at the markets and naturally linking them. I don't think I have a strong view on crypto generally. I worry about assets that you can't value. There's not a way to say, oh, this looks reasonable or not. You also have big volatility moves, as was talked about previously. And so as you get this big gyration, it doesn't necessarily mean that there's an impact in other markets, or you'd at least expect the scale of the translation to be smaller.
And Skylar, you've actually been comforted by the extent of the pullbacks that we've seen in markets. They haven't been panic. I know Cameron Christ was writing something similar to this yesterday. They haven't been panics. Yes, we've seen the VIX spike, but maybe that's rational given where we are in valuations and the narrowness of the market.
Yeah, I mean, when I think about whether or not the market's going to be okay, I'm very comforted by the idea that people are very worried. So if you look at something like the AII bull bear indicator, people are more bearish than not. And typically what you see when a bubble pops is that you get this irrational exuberance. And so the fact that we're not seeing that, to me, is very much a positive sign. I think something that's also worth highlighting is that valuations are not a catalyst. Yes, you can be nervous because of valuations, but it's not a reason for a sell-off. And if you think about the current market we're in, yes, you're likely to see wobbles along the way. We're getting a very chaotic U.S. data release schedule. Yesterday, we had jobless claims released at something like 4 a.m. Eastern time. So that's quite unusual, and you're likely to see volatility induced from that. But the fundamental backdrop is still quite strong. So if you think about what we saw at the beginning of October, that continued or had this wobble. It was three negatives. It was the fact that the U.S. government shut down, China-U.S. trade was going poorly, and people were thinking about a more hawkish Fed recently. But I don't think any of those have gone negative. So you have a trade truce, you have Washington reopen, and the terminal rate for the Fed is still 3%. So that's easing. That's positive for equities.